Good afternoon and welcome to the Greenleaf Financial Fitness Series, 20 minutes to a healthier, wealthier you. Today we will be dealing with politics and finance and hopefully be apolitical if we can pull that off. Just a quick introduction. Here we have Jamie Greenleaf. Jamie helps make these webinars possible. She is a partner and advisor with Cafaro Greenleaf. Here with me today is Jim Hiles. Jim is the managing partner here at First Capital Advisors. And I am Jim D. I am a financial advisor with Greenleaf Financial. Just a quick reminder of our social media platforms. Please remember to follow, like, and share us. We're there on Facebook, LinkedIn, Twitter, Instagram, and YouTube. We have materials out on all those different platforms. We didn't think it was possible today in our presentation called Politics and Finance to not discuss the concept of politics and media. Most Americans tend to get their information from just a couple of sources. So it's good to remember that whatever those sources may be, they're all pretty good at manipulating our thoughts and emotions. We thought we should point that out, and we're definitely not here to do that today. So we wanted to just kind of address that at the top of the presentation. So Jim Hiles, why don't you take us from here?
Sure. So there you're going to see, you've seen already, the hundreds of thousands of data inputs and possibilities and polls and surveys and so on. And there are going to be more, as you know. But currently, if you just took a snapshot, this was as of last week, right now, the Democrats Joe Biden is supposed to be, according to right now the polls, at 50% over Trump at 36% and other at 14%, whoever that may be. So polls are what they are. If you go back to the last election, you can have your own decisions about what you think about polls, but that is a fact in terms of what they're showing. The polls do have some semblance of what could happen and increased probabilities one way or another. So this is where it stands right now. This could all change tomorrow. We don't know. So don't get too caught up in these things. But there are basically three different possibilities, and the odds makers are putting percentages on these now.
Well, these are three of the many possibilities, right?
That's true. That's true. I'm going to say the major ones, I guess I should say. So the Democratic sweep right now has a 50% odds of happening. A Biden presidency with a divided Congress, where the Republicans keep the Senate, has a 10% probability of happening. And then the continuation of kind of where we are today, the status quo, with the Trump presidency at 35%. So help yourself to numbers and statistics, but again, just keep in mind, these are potential outcomes.
Anybody's guess. And obviously, if we look back 4 years ago from where we stand right now, look at what the polls look like, right? So I guess we kind of just knocked that other slide out of the water, right?
Yeah. I think the other thing to look at is, you're looking at the polls and then trying to guess which way the stock market goes. Impossible. Don't try to do that. You don't want to get too overreactive one way or another. So when you talk about what is important, what the fiscal policy, the way we're handling our business cycle, our economic cycle, generally will trump. I'm going to use that.
No pun intended.
Fiscal policy is the key. In other words, it may not matter who the president is. If you look at history, it really does depend more upon what's going on in terms of fiscal policy as it relates to the financial markets in particular. And right now, with the COVID-19 crisis and the policy responses, that's going to make this election more meaningful than perhaps the election itself. So the most important policy factor that will drive the financial markets really is something called fiscal stimulus. That means basically we're putting money in, the government is spending money. They're putting money into the economy because of the impact of COVID-19, which we're not out of the woods yet on, maybe by a long stretch. And you have to have people continue to pay their bills and have income. So the government has stimulated, and they need to continue to stimulate more, in my opinion. But government spending, whether it's COVID now or in the past, when you look at government spending, generally that's much more powerful than who the president is. And the other part of this is tax policy. The equity markets got a shot in the arm back in 2017 when they cut corporate tax rates. That helped profits when they, it makes it more profitable. That could be a possible reversal on the corporate tax cuts going forward, depending on who's elected president.
Right. So obviously it's a little bit different this time, but we still think that fiscal policy is key. So let's take a look at the impact that fiscal policy has had since this COVID-19 crisis started, right? So first we have the $1.9 trillion CARES Act, where we see where that money went. I mean, we saw $468 billion go to individuals, and then we saw a lot of money go to emergency lending, small businesses, and so on. And secondly, we had the $483 billion Paycheck Protection Program. Say that 3 times fast. So with the bulk of that $310 billion of the $483 billion went to small businesses. So, you can see where the rest of that money went, but basically what we're talking about here is fiscal policy, and this is a result of that.
Well, that's monetary policy and fiscal policy. So really what we're talking is both. And you're going to have a lot of opinions as to what policy a president, whether it's Trump or Biden, assuming one or the other gets in there, hopefully somebody will.
I'm sure it'll be one of them.
So maybe neither. But they're saying here's how it kind of lays out. With Trump, no major tax issues or changes, no major changes in federal spending, no major changes in buybacks. Possibly with technology companies and stocks, there's been a lot of talk about antitrust, being that they've gotten too big. Google and Apple and Microsoft are controlling the marketplace, Amazon. This is some discussion around that. There's more focus with Trump and his policies on deregulation. From a trade standpoint, we've had this tariff war go on, and we're pretty much confrontational with anybody and everybody. Maybe for good reason, maybe bad, but that's certainly some things that we're likely to continue to see if Trump stays in. And from a retirement planning standpoint, really no major changes in terms of what we might see there. Biden, on the other hand, looks like there might be a decrease in taxes for low and middle income earners, but there's an offset with an increase in taxes to corporations and high income individuals, possibly the change in the capital gain tax rate. And what you could see from a federal spending standpoint, and notice federal spending is on here for a reason. You could have federal stimulus, this fiscal stimulus, come from both sides. You could have Trump put it in, you could have Biden put it in. So it isn't necessarily one better than the other. We think they both will need to spend money, and that will be the key to our recovery anyway. In Biden's situation, you might have possible limits on stock buybacks. There could be additional antitrust focus on big technology. You've got re-regulation, perhaps, with Biden. You might have, in a traditional sense, trade. You might have a more multinational approach, pushing back on China versus us taking on them. And you might see a change in the tax deduction for retirement contributions. So it really could be an issue for the upper income people. So these are just what we think and what we've seen in the press.
Let's take a look at Federal Reserve policies. We did a whole webinar on the Fed last month, but what impact they have. The Fed basically controls short-term interest rates, right? So if we look at what we covered in last month's webinar, a lot of it's boiled down right here. Low interest rates and Fed policies can affect many different things in your life. The interest that you earn at the bank, the values of stock and bonds, and as well as your real estate values, because the interest rates paid on mortgages, loans, and credit cards is all lower. Consumer spending decisions is driven by Fed policy, and business spending decisions, what they produce, the number of workers they employ or send on unemployment, the investments they make, and getting all the way down to your job, where you live, et cetera. So what we were talking about, Fed policy plays a major role.
I'm not going to say
you don't bite the Fed. Now you may have heard this cliche. The Fed policy affects a lot of different things, and whether you agree with Fed policy decisions or not really doesn't matter, because even if you disagree with their decisions, it's usually unwise to invest contrary to what Fed policies are trying to accomplish. So that's the point there.
Yeah, I think the $5 trillion spent, and maybe another, $1 to $2 trillion coming potentially. And by the way, that's sort of stalled right now, but I wouldn't be surprised if that somehow makes its way through in front of an election. More money to the people is probably good for voting.
Right, could be. Yeah. Or maybe holding out until after, who knows?
Could be. So let's talk about election cycles from a historical standpoint. Really, is one necessarily better than the other, combination-wise, Republicans, Democrats, or divided houses? Do they do better or worse? And what this chart basically says, in the first maybe 0 to 24 months on the bottom here, you might see a pretty wide range of performance in terms of how we're looking at just purely the S&P here, how an index performed. So there could be some dramatic impacts that occur in the short term with the change of a presidency. And in this case, the worst case in the example was a Republican in office in a divided Congress. The next one up, though, is a Democratic sweep. What generally happens is the 18 to 24 months, policies tend to get enacted. And one of the things that bugs the particular market, the stock market, is just uncertainty.
Right.
No one knows what the heck's going to go on. No one knows what's going to be real. Markets get jittery and they potentially lose in value. So what we also see in this chart, though, is when you go all the way out there 48 months, they really are a lot closer than what you might think after a 4-year period. So there's not a huge difference really between what combination of presidency, House and Senate there is. They generally have all been positive, which is interesting. And from a perception of one versus the other, really didn't make that much of a difference.
Right. So basically, it comes back to fundamentals.
So earnings, interest rates, labor growth, productivity, those are the things that are going to drive the economy, and those are going to drive long-term returns. So the economy, in other words, the market, if you will, is bigger than the direction of political winds, meaning that yeah, it might be volatile. We certainly are in this country under pretty volatile times. Doesn't take much to turn on the TV and realize that people are upset and emotions are running high.
A little bit, right?
And what is good in terms of our political system in a way is that there are stops, there are checks and balances. And one of those checks and balances is midterm elections.
Right, huge. Right?
So every 2 years, you're going to have some sort of way of equalizing potentially what maybe some bad decisions or change of direction might be.
Right, and those big differences in the markets, I think, get swung the other way at the midterm elections because of the rebalancing.
Right.
And you talked about this already, the policy initiatives like taxes and spending and markets, also demographics have a big say in what monetary policy is.
That's interesting, the demographic wave of the aging population. We're experiencing that here in the United States. And they're also experiencing that in Europe, in Japan, in China. So there's a huge demographic wave that's coming through that changes the demand on what's important. But let's not also forget that there is another wave that is behind this wave. So it's not just once this rolls through, this is over with. I've heard that before. I don't think so. But I think one of the things we do need to pay attention to is, speaking of the next generation, is these ever-rising debt levels that we've got, which basically are saying, hey, we need to keep interest rates low for a long time because we don't want to sock ourselves with this huge debt and high interest rates. So 2020 election, although it is pretty volatile and will be, it may, we hope it has less impact on the markets like we're suggesting.
How much did the elections matter, right? Let's take a look at who was in office, who was in the White House, and the growth of a dollar since 1926 all the way through the end of 2019. And, we talked about this a little bit, Jim, you and I, about how the narrative of one party is better for the stock market or one party is better for the economy than the other party. We hear that a lot. And I think what this kind of shows us is that's really not true. You see Republican presidents in office where the market didn't do so well, and you see Democrats in where they didn't do so well, and then you see the total opposite. So it has a lot more to do with fiscal policy, as we were just talking about, right? Demographics.
What we do know is what we see on here. The chart goes up.
Right. That is the one thing it's not hard to
aside from 1930,
ignore.
It pretty much still grows in value, and we don't see any reason for that to change.
So this was, we took a look at the high cost of cashing out because we looked at what are some of your choices when you're nervous about an upcoming election and what you might want to do and what some people might start thinking about as we get closer is cashing out, right? Some people say, I just want to get out. I want to wait till things are calm and then I'll get back in again. So, we found this little anecdote here about a steady investor versus an anxious investor. And basically, the steady investor, they were both investing $2,000 per quarter. The difference is that if the market dropped 10% or more, the anxious investor got out, moved to cash, continued to invest their $2,000 a quarter, but did it in cash, and only got back in after a year of positive returns. Of course, 4 steady quarters of positive returns. And you can see how big of a difference the anxious investor and the steady investor were at the end of each one of these, whether it's the tech bubble crash, the global financial crisis, the flash crash. You can see the numbers there. They're enormous, and the coronavirus sell-off, that rebound was so quick that if you got out If you panicked and said, I'm going to wait for things to calm down, they're still not calm, but look at all the money that you left on the table, right?
And investing and emotions don't go together. And this is a great example. And if you're looking truly at your time horizon, and you should be doing this, and just saying to yourself, what do I need this money really for? Is it really for next week, next month, next year? Is it really for 20 years from now?
Right.
If it's for 20 years from now, then go back to this chart and know that observation periods in 20-year rolling periods, stocks and bonds have both been positive for those 20-year periods. So you've got to say, okay, if I just hang on here and roll through this and I need the money 20 years from now, then you should think the same way and don't make any changes.
Right.
A couple of things you could do, you just make sure, so if you don't want to invest in the stock market, frankly, we're not telling you to invest in cash right now either. What do? Make sure you look at some other things that don't behave the same way as a stock or a bond. And in your 401k or in individual accounts, you might look at investing in things that we call alternatives. They're not a stock or a bond. It could be real estate. It could be real estate investments that you have. It could be rental property. It could be second homes. It could be something like that. It could be commodities. It could be investing in gold or precious metals or other types of commodities used in making of telephones, like rare earth metals and things like that. Or you could look at funds which automatically have something called hedges built in. They're designed not to go down as much as the market. On the other hand, they generally don't go up as much as the market either, but you could have those choices available to you as well. And the last thing in here is just a version of the Treasury called TIPS, which is Treasury Inflation Protected Securities, which are bonds which have interest rates which are associated or tied to inflation, which generally is what the impact is going to be of all this printing of money, is at some point we're going to probably have inflation to deal with. And you might want to look at some of these alternative assets, which generally do better when inflation comes around.
Right, and this is something we should be doing all the time anyway. Beware of media overload. This slide's a little bit of an overload, just looking at it. But what we said up top is just no matter where you get your information from, most Americans get them from a very small group of media sources. Just recognize that there is such a thing as media overload, and it oftentimes leads to a lot of stress and anxiety, leaving people not knowing exactly what to do, and that's not a good place to be. Another alternative is just turn it off. If you're one of those people that it does lead to a lot of stress and anxiety, and it's making you wonder what you should be doing with your investments, try to remember what we said here today, and try to remember that the media is not there to help, right? They're kind of there to help stir things up more than anything else.
The power of the clicker.
That's for sure. In summary, long-term returns are similar under each party. I think we saw that. There are a lot of other factors that play into it, so it's not whether it's Republican or Democrat. I don't think one is necessarily good for the markets and one is bad for the markets. We really don't know. It comes back to fundamentals.
In this case, we're really talking about not just fundamentals on stocks and bonds. It really means, are we doing fiscal stimulus or not? And where are we in the business cycle, in the economic cycle? That's what that really means. And by the way, if either party goes in here and does not do fiscal stimulus, the result is probably not going to be a good one, because we still need more help.
Right.
Dealing with the COVID scenario that we really aren't out of yet.
And I don't think anybody disagrees. I don't hear anybody disagreeing with that concept. Right. So important thing is know your risk tolerance, and we have help for that. On GoPlan101.com, we have a risk tolerance profile. You can certainly reach out to us, and we can help you determine what your investment allocation should look like. Know what your time horizon is. That plays a big role in how you should be invested. And know your history, which we tried to show you some of here today. And that about wraps us up. So remember to follow, like, share us, and also feel free to contact us. That's our internet address up there. We also have our phone number, our email address. And remember to join us for our next webinar, which is October 13th at 2 p.m., which is the Retirement Red Zone. We'll talk about getting ready for a comfortable retirement. Hopefully you can join us then. Jim, Miles?
Well, I wish everyone success in their election decisions, and get out there and vote.
Have fun with that.
We said today. We'll talk to you soon.
Have a great day.